Hi everyone, welcome to our monthly video post. In this video, we are going to be talking about something very important when it comes to value investing. Uh, we are going to be talking about the skills, temperamental skills that are key to long-term success in value investing. So, value investing as a concept is very simple. The challenge comes in practice. The large part of success in value investing comes from something called temperamental skills. If you look at very successful, investing organizations, both globally and locally, you will find certain common traits that runs across. It's not their financial skills or any technical competence that gives them competitive edge. The edge really comes from these qualities, which forms a fabric for the organization. Qualities like rationality, objectivity, diligence, ability to stay the course, know to act when the narrative is negative, or willing to go through agonizing wait for the long-term returns. These are the qualities that forms the fabric for very successful value investing organizations. For example, let's take the quality objectivity or rationality. The markets are never rational, right? It swings between euphoric frenzy and manic depression. It either overshoots or undershoots. That's the nature of the beast. In this kind of irrational settings, how does one keep objectivity? If one can keep the objectivity in this kind of irrational setting, then it gives a huge and phenomenal edge when it comes to long-term success in investing. Similarly, the quality to be the other skill is if how do if one can be greedy when chips are down. Again, that brings a huge advantage that will set apart when it comes to again long-term success. These qualities may sound as cliche, but in investing business, they are very, very key to long-term success. The businesses are built or broken by the sheer presence or absence of these skills. Now, why are we talking about this? It's because these skills now command a premium, in a market correction or a down cycle like what we are going through now. In the current market setting, huge correction, the sharp correction, how does one employ these skills to come out, successfully? That's the reason this is relevant for us to discuss. In a rising market, it's very, very easy to put your money because you get proven right very quickly. In few weeks or months, you start initiating a position, and within few weeks or months, the stock price rises and you get proven right, and that adds to the confidence, and then you are willing to allocate even at a much higher price. Exactly opposite happens in a falling market. You start investing when the market starts correcting. Initially you rush to invest because you think that's a great opportunity. Then you put your money, and then when the market continues its fall and the stock which you've invested goes down by another 10-15%, start questioning your logic, and you start holding back, the confidence comes down, then you get in, basically fall into the trap of the accompanying narrative. Unless one is very objective and rational, it's extremely difficult to stick to an investing process, especially in a down cycle. What adds to the challenge is the rising negative narrative in a falling market. One should always remember it is the price action that leads and the narrative follows, not the other way. Just for example, look at the kind of upgrades and downgrades that come from brokerages in a rising bull market and bear market. When the market is rising in a bull market, you see a lot of upgrades from brokerages. When this price starts rising, they come up with a target price of X. When the stock price crosses that X, and then they come up with another target price which is X plus Y. That's exactly what happens in the bear market when the market starts correcting. Brokerages are quick and they're in a hurry to downgrade target prices in a quick succession. One shouldn't get into the trap of this downgrades and upgrades. The way one can keep objectivity in this kind of market setting is to keep off from the narrative and focus on the market cycles, which is price action. Experts will always come and tell you in the media that what suits the narrative and what makes them look smart in the short term, not exactly what is good for the investors in the long term. Coming to the other aspect of being greedy when chips are down, how does one build the skill in a down market? One way one can do this is to follow a very simple yardstick. That is, in a bull market, always discount your MTM by 20-30%, which is that's how you should measure your MTM. Don't take the actual MTM as the real value which you can realize. Instead, take 20-30% discount on the MTM. That's a realizable value. Similarly, in a bear market, when the market starts correcting, apply a premium of 20-30% to the current market MTM value. This way, one can bring discipline to the investing process by setting the right expectation. So, when we talk about all these concepts, the quick and the immediate reaction from investors, generally is all this fine? But look at what's happening around the globe. You have Fed hiking interest rates. We don't know how far they will go, how long they will raise interest rates. And you have balance sheet shrinking. A lot more to go. It is yet to start. When it starts, they have to suck close to about $1.7 trillion over the next 1.5 years. And a lot of noise about recession and global slowdown. And rupee is so far held its level. But what happens if rupee starts falling? And which leads to vicious, issues like twin deficits, like current account and fiscal deficits and government financing. So you can go on like this. So it actually, no one has an answer for all this. We really don't know how this cycle is going to play out. Is it going to play out for the next 3 months, 6 months, 9 months? No one has a clue. It could probably, like what happened in 2006. Market could go through a sharp correction, it could bounce back in just 6 months, and then it can get into a roaring bull market like what happened in 2007. Or it could probably go into a longer down cycle like 2018. We really don't have. Only one thing we can be certain about in this entire uncertain world is that cycles do revert to the mean, and they will eventually revert to the mean. And there's no question of anything else happening, and that one can be very sure about it. And in this kind of settings, how does one take decision to invest? Now, let me give an example. Let's say the stock is trading at 100, and the underlying business is strong, fundamentally very strong, and the stock, given the fundamentals, when the cycles revert to the mean, it could probably go up by 2x, 3x in 2 years or 3 years time. Now there is a risk that this stock, which is trading in this down cycle at 100, could go down to 60, 70, 80 in the next 3 months, 4 months, 5 months. We really don't know. But what is highly probable is that in 2 to 3 years it's going to trade at 200, 300. So it's common sense that instead of waiting for that 60, 70, the stock which is giving you an opportunity at 100, which can move to 200, 300, it's time to allocate that money at 100 instead of waiting for that 60 and 70 and trying to time the bottom. But investors, though it really makes common sense to start investing at that 100 and for that bigger gain of 200, 300 without worrying about the notional losses in the short term of 20, 30 rupees in that stock. Investors always, we've seen this playing out repeatedly in multiple cycles, that investors always wait till the cloud clears, macro cloud clears, till they time, get the bottom on the stock price. By doing this, they eventually miss out the bigger gains of 200, 300. And this has happened time and again in every cycle. And this time too, investors, finally get trapped into the negative narrative and then wait for timing the bottom instead of investing in a phased and stock specific manner in good businesses that can deliver high alpha over long term. But there is a way to make this process simple. That is to keep the long term India story in view while taking your decisions. Recently, happened to read an article from one of the very well respected investor, Mr. Akash Prakash from Amansa Capital. He had just completed his travel and returned from his travel in the US. So let me quote what he had written in that piece. On my global travel, I have not seen investors this optimistic on the long term outlook for India in many years. A combination of geopolitical and China plus one and progressive policy environment in India had led to this. To my mind, if investors had $1 in India, they had 5 to 5.6 in China. Over the coming years, that one will probably move to 1.5, while China will stagnate at 5. This is, however, a multi-year dynamic. So one can't be more bullish than this on India. Of course, it is on the longer run. So to conclude, it's not at all easy to invest in a falling market, but unfortunately, there is no other choice. The only way one can make long-term compounded high alpha returns is by investing when there is a lot of pessimism around. Even though you may get proven wrong in the short term, investing now creates long-term wealth. So if you're an investor with surplus money, I think it is wise to put this money in a gradual fashion and in stock specific stories that have strong and robust underlying businesses. Happy value investing. Thanks for watching this video and see you in the next. Thank you.